The question is not whether gold will rise in 2026. The question is whether you can afford not to own it. Most investors approach gold completely wrong. They treat it like a stock or bond. They expect dividends, interest payments, or capital appreciation. Gold doesn't work that way. Gold is money, real money that has functioned for 5,000 years. It doesn't need banks to verify its value. It doesn't require governments to guarantee its purchasing power. It doesn't depend on financial systems to maintain credibility. Understanding this difference changes everything about portfolio construction. When you own gold, you own money itself. When you own stocks, you own paper claims. When you own bonds, you own debt promises. When you own cash, you own central bank liabilities. The modern monetary system operates on debt creation fundamentally. Every dollar in circulation represents someone's obligation somewhere. Your bank deposits are loans to banks. Government bonds are promises to pay later. Corporate debt requires future earnings to service. This debt-based system works during stable economic periods. Credit expands, commerce grows, and debt gets serviced. But stability requires continuous growth to service obligations. When growth slows, debt service becomes problematic rapidly. Global debt now exceeds $300 trillion. That's 3 times larger than global economic output. Interest payments consume increasing portions of government budgets. Corporate debt service strains cash flows consistently. The mathematics become impossible over time inevitably. Exponential debt growth cannot continue indefinitely on a finite planet. Growth rates required to service obligations exceed realistic possibilities. System stress increases as debt ratios climb. Central banks respond to debt stress through money printing. They lower interest rates to reduce service costs. They purchase bonds to provide artificial demand. They inject liquidity to prevent debt defaults. These interventions preserve the debt system temporarily, but they debase the currency supporting everything. Money printing reduces purchasing power for savers. Real interest rates turn negative for bondholders. Currency instability increases over time systematically. Gold provides protection against currency debasement automatically. It maintains purchasing power during inflation periods. It preserves wealth when currencies lose credibility. It functions independently of monetary policy decisions. The key insight involves understanding gold's independence completely. Gold doesn't require financial system stability to function. It doesn't need government backing to maintain value. It doesn't depend on economic growth to preserve purchasing power. This independence becomes crucial during system stress periods. When banks fail, gold remains valuable money. When governments default, gold maintains purchasing power. When currencies collapse, gold provides wealth preservation. Recent examples demonstrate gold's protective characteristics clearly. During 2008 financial crisis, gold outperformed stocks. During European debt crisis, gold preserved wealth. During emerging market currency crises, gold provided stability. But gold's insurance function extends beyond financial crises. It protects against policy mistakes by authorities. It guards against geopolitical disruptions globally. It provides stability during technological disruptions affecting markets. The insurance comparison explains gold's proper role accurately. You don't buy home insurance expecting profit. You buy protection against unlikely but devastating events. You don't cancel insurance when premiums increase. You maintain coverage against potential catastrophic losses. Gold insurance works similarly in investment portfolios. You don't expect gold to outperform stocks. You expect protection when stock markets crash. You don't expect income from gold holdings. You expect purchasing power preservation during currency crises. The portfolio balance concept requires understanding correlation patterns. During normal economic conditions, stocks and bonds move differently. Diversification works through these correlation differences. Risk gets reduced through asset class diversification. But during extreme stress periods, correlations converge rapidly. Stocks and bonds decline simultaneously during crises. Traditional diversification fails when needed most urgently. Only assets independent of financial system provide protection. Gold typically moves opposite to financial assets. When confidence in financial system declines, gold demand increases. When currency concerns develop, gold attracts investment flows. When geopolitical tensions rise, gold provides safe haven. This negative correlation provides essential portfolio insurance. Small gold allocations can offset large losses. Portfolio volatility decreases through gold's stabilizing influence. Risk-adjusted returns improve through proper gold allocation. The allocation question involves portfolio size considerations. Most financial advisors recommend 5 to 10%. Conservative investors might prefer 10 to 15%. Aggressive investors might accept smaller allocations temporarily, but allocation should reflect personal risk tolerance. Older investors need more stability and protection. Younger investors can accept more volatility theoretically. Wealth preservation becomes priority as assets accumulate. Geographic considerations affect gold allocation decisions significantly. Citizens of stable countries need less protection. Residents of emerging markets face higher risks. Political stability influences optimal gold allocation percentages. Current global conditions support increased gold allocations. Government debt levels reach historical peaks worldwide. Central bank policies maintain inflationary bias consistently. Geopolitical tensions increase rather than decrease. The United States faces unprecedented fiscal challenges. Annual deficits exceed $2 trillion regularly. Interest payments consume 20% of revenues. Social Security and Medicare create unfunded obligations. European nations face similar debt sustainability questions. Demographics create pension and healthcare pressures. Energy dependence creates economic vulnerability significantly. Political divisions complicate policy responses to crises. China's debt levels approach concerning ratios rapidly. Local government obligations exceed official statistics. Property sector problems threaten financial stability. Trade tensions create additional economic pressures. These debt dynamics support gold ownership strategically. Currency debasement becomes necessary to manage obligations. Inflation reduces real debt burdens for governments. Savers suffer wealth confiscation through negative rates. Central bank gold purchases validate private ownership decisions. They've bought over 800 tons annually. Their actions contradict official monetary policy rhetoric. They demonstrate institutional recognition of gold's value. The Federal Reserve maintains significant gold reserves. They haven't sold gold despite balance sheet pressures. They recognize gold's importance during currency crises. Their actions speak louder than public statements. European central banks reduced gold sales significantly. They stopped coordinated selling programs from previous decades. Some banks increase holdings through purchase programs. Policy reversals indicate changing official attitudes. Asian central banks accumulate gold reserves aggressively. China leads purchases with strategic accumulation programs. India increases reserves despite import cost considerations. Turkey builds reserves despite domestic currency pressures. These official sector purchases reduce available supplies. Central banks remove gold from circulation permanently. Private investors compete for remaining supplies. Reduced availability supports price stability long term. The mining supply situation supports gold ownership. Annual production equals approximately 3,000 tons globally. Mine development takes years, requiring massive investments. Exploration success rates decline as deposits depleted. Environmental regulations restrict new mine development increasingly. Community opposition delays projects for years. Water and energy costs increase mining expenses. Ore grades decline, requiring more processing. Existing mines face depletion schedules inevitably over time. New discoveries cannot replace depleting reserves adequately. Supply growth lags demand growth consistently. Scarcity value increases over time naturally. Recycling provides some supply, but faces limitations. Jewelry recycling depends on price levels significantly. Electronic waste recovery requires expensive processing facilities. Cultural factors affect recycling rates in regions. The supply constraints create long-term price support. Demand continues growing while supply growth slows. Price appreciation becomes necessary to balance markets. Gold ownership benefits from these supply dynamics. Investment demand patterns support continued gold accumulation. Exchange-traded funds make gold accessible to institutions. Individual investors increasingly recognize gold's portfolio benefits. Wealth management firms recommend increased gold allocations. Demographic trends support gold demand growth substantially. Baby boomers prioritize wealth preservation over growth. Millennials face currency instability throughout careers. Generational wealth transfers favor stable assets. Technological developments make gold ownership easier. Digital platforms enable fractional gold ownership easily. Storage solutions reduce physical holding complications. Insurance options protect against loss risks. But physical possession provides maximum independence benefits. Vaulted gold eliminates counterparty risks completely. Direct ownership ensures access during system disruptions. Storage costs represent insurance against system failures. The storage decision involves practical and security considerations. Home storage provides immediate access, but security risks. Bank-safe deposit boxes offer security but access limitations. Professional vaulting provides security with access flexibility. Insurance considerations apply to physical gold holdings. Homeowner policies may exclude precious metals coverage. Separate precious metals insurance may be necessary. Professional storage often includes comprehensive insurance coverage. Tax implications vary by jurisdiction and holding method. Physical gold may face capital gains treatment. ETFs might provide tax advantages in accounts. Professional advice helps optimize tax efficiency strategies. Estate planning considerations favor physical gold ownership. Precious metals transfer easily to beneficiaries. Physical assets avoid probate complications potentially. Generational wealth preservation through gold works effectively. The psychological aspects of gold ownership matter significantly. Physical possession provides confidence during crises. Tangible assets create emotional security feelings. Independence from financial system reduces anxiety levels. Gold ownership doesn't require market timing skills. Dollar cost averaging works effectively with gold purchases. Regular accumulation reduces price volatility impact. Long-term perspective eliminates short-term fluctuation concerns. Market timing approaches often fail with gold investments. Price movements can be volatile short term. Economic factors affect gold prices unpredictably sometimes. Speculation can lead to inappropriate allocation decisions. The key involves treating gold as insurance. Insurance costs money rather than generating returns. Protection value exceeds return considerations for insurance. Peace of mind justifies insurance premium costs. Gold provides similar peace of mind benefits: portfolio stability during market turmoil periods, wealth preservation during currency instability episodes, independence during financial system stress events. Modern portfolio theory supports gold inclusion mathematically. Gold's low correlation with stocks reduces volatility. Risk-adjusted returns improve through diversification benefits. Sharp ratios increase with optimal gold allocations. But portfolio theory assumes normal market conditions. During extreme stress periods, traditional relationships break. Only truly independent assets provide protection benefits. Gold qualifies as genuinely independent portfolio component. The independence factor becomes crucial during system failures. Gold functions regardless of electricity availability. It doesn't require internet connectivity to verify value. It doesn't need government authorization to transact. These characteristics matter during emergency situations increasingly. Natural disasters disrupt electronic payment systems regularly. Cyber attacks threaten digital financial infrastructure constantly. Political instability can freeze traditional banking systems. Gold provides backup payment system during disruptions. Local merchants accept gold universally during crises. Precious metals enable commerce when systems fail. Physical money works when digital money doesn't. The privacy aspects of gold ownership attract attention. Cash transactions provide anonymity increasingly rare today. Physical possession avoids electronic surveillance systems. Financial privacy becomes valuable during uncertain times. Government policies increasingly monitor financial transactions carefully. Bank reporting requirements capture most money movements. Digital currencies enable complete transaction surveillance, potentially. Physical assets provide privacy alternatives during restrictions. But gold ownership must comply with tax laws. Reporting requirements vary by jurisdiction and amounts. Professional advice ensures compliance with regulations. Legal ownership avoids unnecessary government attention problems. The international aspects of gold ownership provide benefits. Gold is recognized globally as valuable money. Border crossings accept gold as wealth storage. International travel benefits from gold's universal acceptance. Currency restrictions affect international wealth transfers significantly. Capital controls limit money movement across borders. Gold provides alternatives when traditional transfers fail. Portable wealth crosses jurisdictions more easily. But international gold transport faces legal restrictions. Customs regulations apply to precious metals movements. Declaration requirements vary by country significantly. Professional services help navigate international regulations properly. The inflation protection characteristics of gold work automatically. Gold prices tend to rise with general prices. Purchasing power gets preserved during inflationary periods. Real wealth maintenance occurs without active management. Historical data supports gold's inflation hedge properties. During 1970s stagflation, gold outperformed dramatically significantly. Recent inflation episodes show gold's protective benefits. Long-term purchasing power preservation works consistently, but short-term performance may disappoint during periods. Gold doesn't move with inflation immediately always. Other factors influence gold prices beyond inflation. Patient ownership perspective becomes necessary for success. The deflation protection aspects of gold provide insurance. During deflationary periods, cash gains purchasing power. But deflation often accompanies financial system stress. Gold provides stability during deflationary debt crises. The 1930s depression demonstrates gold's deflation benefits. Gold ownership was restricted but valuable. Currency devaluations increased gold's purchasing power. Physical assets outperformed financial claims dramatically. Modern deflation scenarios might favor gold similarly. Debt defaults would stress financial institutions severely. Currency instability could develop during deflationary pressures. Gold ownership provides protection against both outcomes. The technology disruption factor supports gold ownership currently. Artificial intelligence threatens traditional employment patterns. Automation reduces human labor requirements significantly. Economic disruption creates uncertainty about futures. Digital currencies and blockchain technology change money concepts. Central bank digital currencies enable unprecedented control. Financial surveillance capabilities increase through technology advancement. Physical assets provide alternatives to digital systems. But technology also threatens gold's traditional functions. Digital payments reduce physical money usage. Cryptocurrency adoption provides alternative value storage. Technological change creates both opportunities and threats. The geopolitical dimension of gold ownership grows important. International tensions increase rather than decrease globally. Trade wars disrupt traditional economic relationships significantly. Military conflicts threaten regional stability consistently. Sanctions weaponize financial systems against participants regularly. Swift exclusion isolates nations from dollar systems. Alternative payment systems develop, reducing dollar dominance. Physical assets avoid sanctions exposure completely. Gold provides neutral wealth storage during conflicts. It doesn't represent any particular nation's obligations. Universal acceptance transcends political boundaries effectively. Value preservation works regardless of political developments. The energy transition implications affect gold indirectly. Renewable energy systems require massive infrastructure investments. Mining operations need enormous amounts of energy. Environmental policies restrict traditional mining operations. Climate policies favor renewable energy over fossil fuels. Carbon taxes increase mining costs significantly worldwide. Environmental regulations delay mine development projects consistently. Green policies inadvertently restrict gold supply growth. But energy transition also supports gold demand. Infrastructure investment creates inflation pressures potentially. Government spending programs require deficit financing increasingly. Monetary accommodation supports precious metals fundamentally. The demographic factors support continued gold demand. Aging populations prioritize wealth preservation over growth. Retirement planning favors stable value storage methods. Pension fund allocations include precious metals increasingly. Younger generations face currency instability throughout careers. Student debt burdens limit traditional investment capacity. Housing affordability crises delay wealth accumulation significantly. Alternative assets, including gold, attract younger demographics. Generational wealth transfer accelerates over coming decades. Baby boomers accumulated wealth during stable periods. Millennials inherit wealth during unstable monetary conditions. Gold provides intergenerational wealth preservation effectively. The conclusion about gold ownership in 2026 emerges clearly. Gold provides essential portfolio insurance against uncertainties. Financial system stability cannot be assumed indefinitely. Currency debasement continues through policy requirements. Gold ownership isn't about market timing or speculation. It's about wealth preservation during uncertain periods. It provides stability when traditional assets fail. It offers independence from failing monetary systems. The question isn't whether gold will appreciate. The question is whether monetary systems remain stable. Historical evidence suggests they won't over time. Mathematical analysis confirms debt sustainability problems. Gold provides financial resilience against these uncertainties. Small allocations can offset large portfolio losses. Purchasing power gets preserved during currency crises. Wealth transfers across generations through gold ownership. Understanding gold's proper role enables appropriate allocation decisions. Insurance, rather than investment, motivates ownership correctly. Protection, rather than profit, drives allocation strategies. Stability, rather than growth, guides holding periods. The case for gold ownership in 2026 remains compelling. Debt levels continue rising rather than falling. Central bank policies maintain inflationary bias consistently. Geopolitical tensions increase rather than decrease. These conditions support gold's insurance function fundamentally. Portfolio protection becomes more valuable than return. Wealth preservation matters more than wealth accumulation. Financial resilience provides security during uncertain times. Gold ownership in 2026 represents prudent risk management. It provides insurance against monetary system failures. It offers protection against currency debasement policies. It ensures portfolio stability during crisis periods. The decision involves recognizing gold's unique characteristics. Real money without counterparty risk entirely. Value storage independent of financial systems. Purchasing power preservation during uncertain periods. These benefits justify gold ownership regardless of prices. Insurance value exceeds return considerations for gold. Protection benefits transcend short-term performance metrics completely. Long-term perspective enables appropriate allocation decisions. Gold remains an essential portfolio component in 2026. Uncertainties continue increasing rather than decreasing globally. Monetary system problems persist rather than resolve. Financial resilience requires independent asset ownership. The wisdom of gold ownership becomes apparent. It provides stability during instability periods consistently. It preserves wealth when currencies fail repeatedly. It offers independence when systems become unreliable. Gold ownership in 2026 represents financial preparedness. Uncertainties require defensive asset allocation strategies. Traditional diversification fails during extreme stress periods. Only independent assets provide genuine protection benefits. Understanding these dynamics enables informed decisions about ownership. Gold provides essential insurance against system failures. Portfolio allocation should reflect these protective characteristics. Financial resilience depends on proper gold allocation.